Catherine, I think we can start. So good afternoon, everybody. My name is Kola Olofinboba, and I am a managing partner at Fairview Capital. Welcome to this webinar on the Illinois State University's Retirement Systems Program for Diverse and Emerging Managers. This program has been a leader in demonstrating what can be achieved with intentionality and a focus on performance through investing in an undercapitalized yet opportunity-rich segment of the market. This webinar has over 200 participants, demonstrating once again that the interest in this area of investment remains very strong. At Fairview, we have been partners with Illinois State University's retirement systems for over a decade and are honored to co-host this webinar with their team. The agenda is robust, starting with an overview of our respective organizations, Fairview and Illinois SURS. We will quickly transition to an overview of the Illinois Pension Fund environment, then focus specifically on the SURS program, also known as the Lincoln Fund. Finally, we will use this opportunity to shine a spotlight on two of the managers in the program who will share some of their experiences founding new firms and interacting with limited partners, including the SURS program through Fairview. The Q&A will happen at the end, so please use the Zoom Q&A function to submit any questions you might have. We will try to answer all questions submitted, but if we're unable to get to any of them, we'll reach out directly afterwards. First, we're going to make some speaker introductions. On the next page, yes. So the other speakers today will be Kim Pollard, who is a senior investment officer with SURS and who, along with the rest of her team, has worked closely with Fairview to build a best-in-class program as a core part of the SURS portfolio. Also speaking are two of my partners from Fairview who work very closely on this program, Aka Vashani and Kwesi Kwe. And we have the founders from two of the highlighted funds, Nisha Dua from BBG Ventures and Renata Quintini from Renegade Partners, who will also be talking during the fund highlight spotlight. Next page. So a few words about Fairview. Fairview was founded in 1994 with an objective to provide unparalleled access to compelling segments of the private market, which included emerging and diverse managers, and always focused on delivering strong returns to our limited partners. Since inception, we have managed funds with an aggregate capitalization of $10.5 billion, working with many of the most sophisticated institutional investors in the space. Next page, please. We do three main things for our clients. First, and pertinent to the conversation today, we invest in diverse and emerging manager-led funds. Next, we invest in best-in-class, tenured, and difficult-to-access venture capital funds. And then very selectively, we co-invest with funds in the first two areas, directly in companies. With regard to the emerging and diverse manager space, Fairview plays a unique role. We've been doing this the longest, for almost 30 years since our founding. We currently serve 26 clients in the space, many of which have worked with Fairview for decades, including pension plans, both public and corporate pensions, insurance companies, endowments, foundations, and family offices. And we have invested in over 110 diverse and emerging managers, with over 40 of them being first-time funds. At this point, I will hand over to Kim to talk about SURS and their program.
Thank you very much, Kola, and thank you to Fairview for co-hosting today. We appreciate the partnership with Fairview very, very much. Thank you also to all of you who are joining. We appreciate your interest in SURS and taking the time to learn more about our private equity program. Again, as Cola said, my name is Kim Pollitt. I'm a senior investment officer at SURS, and I'm responsible for overseeing the private equity program. I thought I might take a minute just to give you a little bit of background about SURS in case you're not familiar. SURS is a public pension system covering employees of Illinois' public universities and community colleges. We administer both a defined benefit plan and 2 defined contribution plans. But the focus of today's discussion is really the defined benefit program, which is about $23 billion at the end of June. So, diversity has really been a longstanding priority at SURS, and at the end of June, over 44% of our DB assets are managed by minority-owned and women-owned firms. And in dollar terms, that's just over $10 billion, and that is invested through 38 managers across pretty much every asset class: public, private, stocks, bonds, alternatives. The main initiative there is called the Manager Diversity Program. It's been in place since 2004. That's headed up by Alex Ramos on our staff. Again, the focus today is really on the private equity segment. So, the Illinois statutes really have some unique features, I think, on the topic of diversity compared to other states. So, for example, the Illinois Pension Code explicitly encourages the use of emerging and minority investment managers. That's across all asset classes. In fact, the statute goes on to say that this is to be done to the greatest extent feasible within the bounds of financial and fiduciary prudence. So it's pretty strong language, I would say. That same statute also includes the requirement to establish policies and goals for the management of assets by emerging and minority investment managers, and also has an aspirational goal at the total fund level that at least 20% of assets be managed by emerging managers. Along with that is an annual reporting requirement. And I've noted the location in the statute in case you're interested. There's certainly more in that area, but I've just highlighted a few of the relevant points. So what do we consider a minority investment manager? It's a good question. It's a question we get a lot because it varies from state to state so much. And in Illinois, of course, we follow the definition in our statute, which is, so to qualify as a minority investment manager, the firm has to be at least 51% owned by minorities, women, or persons with a disability. And I included the site below for the statute. There's very specific definitions for each of those terms as well. This slide really just gives you a snapshot of our goals at the end of June. So if you look at the rightmost column, the overall goal is that 35% of the total plan be managed by minority investment managers. Actually, at June 30, we were at 44%. So what it means really is, so as we build out and manage the portfolio, not just private equity, but across all asset classes, diversity is an important part of the discussion, and it really has been for a long time. So let's move to the private equity portfolio. SURS has been a private equity investor for a long time, dating back to about 1990. We first invested via separate accounts, and then a little bit later through fund of funds historically. And then what we did, we supplemented the broad fund of funds mandate with specialty mandates that used a diversity lens in their process. So for example, I think the first private equity program there to point to is in 1999. We worked with Progress Investment Management at the time, and they started a diverse focused program in private equity for us. And then 2004, we began working with Mueller and Monroe in a similar mandate, and they continue to work alongside us today. And then as Cola mentioned, we started working with Fairview, I think in 2013 or early 2014. So it's been a decade. It's been a long time. I can't believe it's been that long. And so over time, the allocation to private equity increased. But in 2018, as a result of an asset liability study, the policy target increased from 6% to 11%. So, a near doubling at that time. And that really prompted us to step back and kind of reevaluate how we invest in private equity. So late in 2018, the board authorized a search. And to make a long story short, Torrey Cove was selected. Torrey Cove is now Axia, of course, and they were selected as discretionary private equity advisor in 2019. We think that was the right decision for SURS for a number of reasons, but it allows much greater control over the top line strategy. You know, using fund of funds previously, LPs really have little control over top line strategy, and we were using 3 global fund of funds. We also have more control over how much diversity is in the portfolio. Axia has a minimum of 20%. 20% of the commitments need to go to diverse firms. And I'm happy to say since they've been retained in 2019, that number is closer to 30%. And again, we think it's more cost effective to do it this way. So let's fast forward to today. You know, there's so many different ways to build a private equity program. This is just how we've chosen to do it. So the first step is really to set top level portfolio construction guidelines. This is in terms of strategy diversification, geographic diversification, that sort of thing. And then once those parameters are in place, we focus on implementation. We have 2 fully discretionary partners. I mentioned Axia. They have been in place since 2019. Axia focuses on US and global funds of $300 million and up in size. They tend to gravitate towards the mid-market buyout space, I would say. And then again, they have the diversity mandate as well, or 20% or more to diverse firms. And so with that Axia portfolio, with those guidelines in place, we really were very intentional about how we wanted to build the portfolio with Fairview, because we wanted it to be complementary to the program that Axia is building. And we have really 2 main priorities here. The first one, we want to be an active investor in the small end of the buyout and venture markets. And we want to be an active investor among diverse general partners. You know, we think there are performance advantages there. And we also think there are benefits to being an early investor in terms of improved access down the road. So we're trying to take a long-term approach here. And so with those 2 things in mind, we sat down with Fairview and designed a portfolio really to do just that. And so on this page, I know Fairview is going to talk more about it, but our current iteration of the Lincoln Fund series with Fairview, they focus on North American funds up to 500 million in size. So we're looking at the smaller part of the market. There's much more of a focus on venture capital here because that's what you see in the small part of the market. And then the Lincoln Fund is exclusively focused on minority investment managers. Okay. Next slide, please. This slide is just for your reference, some contacts, both at SURS, at Axia, and Fairview. I want to give a quick plug to our diverse manager portal. This is a new feature, and you can find it on our website at surs.org. And it's a new feature that allows managers across asset classes to schedule meetings directly with SURS staff. And so be patient. There is some limited access there, limited slots, but we are adding more, and we're trying to improve that over time. So it's a new feature, and we want to make sure everybody knows about it. And so with that, I think I'll pass it to Kwesi.
Great. Thank you, Kim. And thank you to everybody on the call. So given the remarks so far, it is clear that Illinois features a unique environment for diverse managers. Illinois has several public pension plans, including SURS, which are organized based on different employee groups and government entities. These funds may provide retirement, death, and disability benefits for its employees and their surviving spouses, children, and other dependents. Investments made by the fund must satisfy the conditions of the Illinois Code, namely that fiduciaries, which are typically Board of Trustees and investment staff, must at all times execute their responsibilities in a manner consistent with the stated mission of the fund. That is, to optimize the total return of the fund's investment portfolio through a policy of diversified investments and prudent risk management, while ensuring transparency and compliance with applicable laws and regulations. And as Kim noted earlier, the Illinois Pension Code outlined that it shall be the aspirational goal for a retirement system pension fund, or investment board, subject to the code, to use emerging investment managers for no less than 20% of the total funds under management. But importantly, Illinois plans have long encouraged trustees to use minority and women-owned investment managers to manage their system's assets. And the thinking makes sense. Many of the employees are those that paid their fair share into the pension plans over several years and were promised a pension at a future date. Many plan participants are women and minorities, and the general thinking is that those that manage the assets of the pension plan should be reflective of the participants in the plans. Board, investment staff, and the consultants to the plans are integral to managing the plan's assets. Some plans have general consultants that provide advice and largely serve as an extension of investment staff, providing recommendations on asset allocation and manager selection. And in some cases, consultants specialize and offer services for specific asset classes. So the fundamental question now is, how does one have an opportunity to manage Illinois plan assets? Well, to begin with, Illinois plans first identify a need for a qualified investment manager to render services. This is done through a request for proposal, otherwise known as an RFP, or a request for information, otherwise known as an RFI process. The plan will typically have questionnaires addressing the organization, the team, the strategy, the track record, the processes, the compliance, and other firm and product-specific matters. These RFP and RFI processes are highly competitive and typically involve staff, consultant, and board action diligence and decisions. Each one features different characteristics, requirements, and processes. Several public pension plans in Illinois have taken steps to promote diversity through emerging manager programs or similar initiatives. The provisions and actions to date reflect the state's commitment to promoting diversity and inclusion in investment management, while also emphasizing the importance of maintaining strong investment performance for the benefit of the pension systems and their beneficiaries. And so SURS developed the Lincoln Fund program to enhance access to diverse and emerging managers. And I'll turn it over to Akar, who will explain the Lincoln program in greater detail.
Thank you, Kwesi. And Illinois certainly is a unique market for emerging managers, and that's really good background for background context for launching the Lincoln Fund. And Kwesi also worth noting, has experience as an investment officer at Cook County in Illinois, which has been helpful to our team. So shifting gears to some background on the program that we manage for SURS, the Lincoln Fund. As we've mentioned, we began working with SURS in 2013, officially established the Lincoln Fund program in 2014 with a initial $75 million commitment from SURS. And I think we really do need to commend SURS staff and board for their vision and belief system, especially at that time. In 2013, when we first partnered with SURS, we were about 4 years removed from the Great Recession. There were very few LPs starting emerging manager programs in Illinois or across the country, for that matter. The perception of risk for on the part of most LPs was incredibly high, somewhat similar to what it is today in some ways. And there were also many misperceptions about the opportunity set. So to launch a program like this with high return expectations, recognizing the opportunity with diverse managers, really did stand out at the time, and we think set a great foundation for where the program is today and how it's evolved. We've had a wonderful partnership over the years. The structure has been very thoughtful. We work very closely with staff, as Kim mentioned, on guidelines. We communicate regularly on opportunities, but Fairview has discretion on the ultimate investments, which has proven to be really important. It does several things. It eliminates any potential conflicts. It allows us to invest purely. It allows us to move quickly on opportunities, support managers when they need it. It allows us to be inclusive as possible of managers while really reducing any risk of adverse selection. And again, it may seem nuanced, but these elements are definitely unique in the pension plan world, and we think have truly contributed to the program's success. Over the years, we've more than tripled the size of the program now. We've backed some amazing managers over the years that have many of them which have now gone on to become some of the leading diverse firms, but really just leading firms, period, in the industry. And we've, of course, benefited from some great performance along the way. One of the other important elements to highlight here about this program is how nimble that it's been and how it's evolved over time. So in 2014, as Kim alluded to, SURS was essentially investing in private equity solely through funds of funds and separately managed accounts or funds of one. And so for that reason, when we first partnered with SURS, the program was designed to match their private equity program's allocation target. So you can see there was a heavy emphasis on buyout strategies. There was a low cap on the venture exposure, essentially no cap on fund size and no limitations on fund sequence. And then between Series A and B, SURS transitioned its private equity program, again, as Kim described. And the sophistication of the program was clearly building for some time. It made sense for SURS to invest directly into funds versus relying exclusively on funds of funds. A pretty natural transition, we think, one that made sense for most plans, especially as private equities become more mainstream. But with that background, when we're designing Series B, we wanted to have a program that would complement what SURS was doing directly. The larger diverse firms are more or less known today, and SURS can write bigger checks and access those opportunities. So we deliberately changed focus to be focused on smaller funds, less than 500 million, as Kim mentioned, and also on newer firms. So those that are raising first, second, or third time institutional funds. What we did not change over time was our discipline around pacing and portfolio construction, as well as obviously the exclusive focus on best-in-class diverse managers, and again, with the goal of driving out performance. The other important thing to note about the evolution of program is that the diverse manager opportunity set has also changed a lot over the years, and we've been able to reorient the program to be much more inclusive over the years. So for some additional context, we thought that the next few slides would be helpful for folks to understand the program's evolution over time on a few fronts. These are actually slides from a mid-year webinar that we did about a month ago on the woman and minority-owned firm market broadly. And so if you're interested in a lot more detail on this topic, you can find the full recording of that session on our website. But just to quickly highlight a few things. So on this slide, you'll see just the opportunity set of firms that are majority woman or minority-owned in the US. This has grown over 8x since the inception of the program. When we started in 2014, there were roughly 100 managers in the country that would have fit the mandate. That grew to about, well, actually over 200 by the time the investment period ended for our first pool of capital, and continued to expand from there. And so it did take a true, belief in the growth of the opportunity set at that time. To us, it was pretty clear. We knew there would be no pipeline issue, and I think thankfully, SURS was early in recognizing that along with us. And today, just having such a large opportunity set in pipeline means that we are more selective, but market coverage and manager selection matter a lot more than it did before. On the next slide, you can see the evolution of the fund sequence of diverse managers in the market over time. This has shifted a bit, but the main takeaway is that over 90% of the opportunity set lies with first, second, and third time funds. So another reason why it made sense to orient Lincoln Fund Series B over to first, second, and third time funds. Here, no surprise that over 90% of diverse managers are actually raising funds less than 500 million. Again, made total sense to focus on smaller funds. And then finally, as Kim mentioned, we shifted focus to venture capital funds over time. This also aligned really well with how the diverse manager opportunity set has evolved. When we first started Lincoln Fund, the majority of diverse firms were raising buyout funds. And as you can see, that changed pretty significantly over time to today, where about 75% of diverse firms are raising venture capital funds. And fortunately, that's an area where we have a significant amount of experience and expertise. And so that helped make that shift very successful for us. And so all that taken together, these are the guidelines now today for Series C, which is our active pool of capital. And we think we're very well aligned with where the diverse manager market is. We can be totally inclusive, and the program complements SURS' direct private equity program extremely well without any overlap. One of the questions we get asked all the time is, what are we looking for in managers? It does start with performance. I know we keep mentioning that, but that is the real goal. And of course, We know that diverse teams outperform, small funds outperform, new firms outperform as well. Tons of data on that, including our own experience. So with this series, we just wanted to continue to invest with the best firms in that category broadly. What does that encompass? It usually means, we're looking for teams with experience and track records. Even though we do a lot of first-time funds, these are typically not folks that are completely new to investing. The strategy and approach has to be differentiated. We think that managers should have tangible advantages there. Teams need to be committed to each other and to building their firms into enduring platforms. We're not just fund investors. We want to find and invest in entrepreneurs and firm builders. We also get a lot of questions around strategy within venture capital and buyout, and what do we look for in those two strategies in particular. I would say that things that I mentioned already, regardless of strategy, are very important. But I would say specific to venture capital, we have an emphasis on the ability to generate top decile or better returns. A big part of that comes down to portfolio construction, ownership, and maybe most importantly, the ability to intersect and invest with the best entrepreneurs of the next generation, the ones that are going to build the most consequential companies of the next generation. And so a lot of that depends on deal flow and access to opportunities as well. But it helps to be thesis driven, but also not too focused that you limit your opportunity set relative to other firms. So those are some of the high level things on venture. And then with respect to buyout funds, obviously there's not as high of a dispersion of returns in that segment, but being the best firms does really matter. And we're looking for advantages in things like sourcing and winning deals, the ability to add value to companies operationally through add-ons, and not a reliance on financial engineering, multiple expansion, et cetera. We do like the tech buyout category, but we invest across verticals. If there's a growth component, that's always a plus in terms of industry tailwinds. And the focus is generally lower middle market, small market. That would be our preference. And of course, smaller funds. So the next slide gets into our process. And again, we're inclusive and comprehensive as possible. We're very thesis and research driven, but most importantly, we have this open door policy, and we want to be open to every diverse firm in the market. This is not a transactional program for us. We want to build relationships, get to know firms, try to be helpful, be a conduit to the broader diverse and emerging manager community to the extent we can be. Now, every opportunity is obviously not a fit. We are selective. If you do the math, the conversion rate is between 2% and 4% across Series B and C so far. But if you're a GP, don't let that discourage you. There's, usually what we say is that a no is not a no forever. We really do actively track the progress of firms over time. We want to stay in touch regardless of whether or not there's an immediate fit. And, we do believe that capital is not the only thing that a program like this can provide. But a fit for an allocation, we do think can develop over time as well. The diligence process itself is on the next slide. And, in the interest of time, we won't go through it in excruciating detail, but as you can see, it is pretty thorough. This is a time-tested process. It's been refined over almost 30 years now of Fairview doing this work. And I would say we're actually very efficient. We don't look to waste the time of GPs, and we will always be transparent about where things stand and where a manager is in the process. But if you do find yourself deeper in the process, it for sure will be very involved and thorough. And then, just finally, before we get to our manager spotlight section, post-investment, what do we look for? We look to be active partners to our managers. Formally, that can mean being on the LPAC, but beyond that, what we care about most is supporting our managers in building their firms. And that can take a lot of different forms. And we have 30 years of institutional knowledge, a large roster of best practices that we can pull from there. We also want to be long-term partners. So as long as firms do what they say they're going to do and perform, we will be there. Through the Lincoln Fund, we actually have the ability to invest not only in first, second, or third time funds, but also 3 subsequent funds, regardless of which fund we enter at. And then SURS has also successfully over time transitioned many Lincoln Fund relationships to direct relationships. This has so far primarily been from the Series A portfolio to date, but we do expect that more of that activity will continue with the subsequent series. And then so to wrap, both SURS and Fairview have a real commitment to investing with diverse and emerging managers. It really does start with this shared belief system that we have, which goes back to the launch of the program that I talked about. And the willingness to evolve with the market, we think, has been really critical to this program. And we're also lucky to have SURS as a partner that recognize the importance of alignment in this endeavor. And we've been fortunate to be able to build this unique platform in a meaningful way, in a collaborative way, together almost over a decade now. And we are both committed to the strategy for the long term. So with that, we wanted to kind of next give everyone a chance to hear directly from some GPs who are part of the program. And I will pass it on to Kwesi to kick off our manager spotlight.
Great. Thanks, Akar. So now shifting to our manager spotlight, I'd like to introduce Renata and Nisha, both GPs within the Lincoln portfolio. So beginning with maybe Nisha, can you provide a brief summary of your firm, how you got started, and your firm's genesis story, and then Renata will follow right after.
Sure. Hey, everyone. Great to see you. So we're BBG Ventures. We invest in early stage female or diverse founders who are building at pre-seed and seed in an arena that we describe as the polycultural future of America. So particularly those overlooked consumers for whom existing systems aren't working. We're looking for founders who are building in the biggest arenas of the American economy, which we think need big reinvention through technology. So healthcare, future of work, financial inclusion, climate, and generally speaking, building for those overlooked consumers. So we are really looking for founders who we think want to move the world forward, right? Who take their lived and learned experience and are really at the intersection, I think, of both humility and world-changing ambition. We are best known as one of the first funds to put a stake in the ground around backing female-led teams. And that has really come out of our experience as consumer operators, right? So where are American priorities, behaviors, and attitudes shifting? And how can we follow the nose of the consumer to find opportunities for venture capital? When we launched in 2014, and I think this is a thread of thinking about how to invest in diverse managers, particularly those investing in diverse founders. For us, it was always really about a thesis that we can find alpha by backing those founders because they would have unique experiences that make them more qualified to be building solutions here. So we did not launch with a DEI mission per se. And that has also enabled us to stay nimble about where the consumer is going. So while when we launched, it was about women as the dominant consumer, that profile has changed today, right? We're actually about to publish a piece on this. What does the American consumer or user look like today? Gen Alpha will be the first majority minority generation, in history. And we're embarking on this, I think, incredible generational turnover of power. And so between the changing composition of race, the widening wealth gap, and aging population, there's significant opportunity that isn't just about women, but that's certainly how my partner and I came together. Susan, my partner, has followed the female consumer to success her entire career. She greenlit shows like Desperate Housewives, Grey's Anatomy, The Bachelor when she was at ABC. She ran Martha Stewart when Martha was in jail. We won't get into stories there today. And she was the first CEO of Guilt. She and I met working together, and you talk about VC partnerships being a marriage. We've been working together for over 10 years. And I was building something called Built by Girls. I'd run a website that was focused on teenage girls. And so we really came together around this idea of who is the dominant consumer. And at that time, it was women. So we've certainly evolved our understanding of where Americans, or the 99%, are headed. And I think we've really found success in building a track record One, because of our understanding of the American user, but two, because of our experience as operators. And so we have a bit of a different spin out story. We're not a spin out from a traditional fund. We worked together doing 2 proof of concept funds at AOL, and that enabled us to build our track record. So while we had a solo LP for those first 2 $10 million funds, we then had to go from 0 to 50 for our first institutional fund. So maybe some different lessons on the fundraising side there.
Sounds good.
Yeah.
And Renata, same question.
Yeah, such a pleasure to be here, and thank you, Illinois SURS and Fairview, for the support. And I'm hearing Nisha's story here, and I find so many parallels to the origin story of Renegade. So one of co-founders of Renegade, we're an early stage venture capital firm. We invest in companies post product market fit, and we help them build and scale their operations. So think of Series A and B as our sort of middle of the fairway. So following Nisha's investments or seed companies like that, but very much like our story was bottoms up, and BBG was focused on what the consumer wants, and Renegade story was focused on what operators and company need. So I've been in venture for 16 years now. My co-founder Roseanne has been in venture for 12. So I've been at Felicis and Lux Capital. She's been at IVP and Canaan, and we've been investors for our careers. We've invested around $500 million in companies that created $40 billion at exit. So think of category defining companies like Dollar Shave Club, Cruise Automation, Masterclass, Looker, and many others. And through our board experience, what we noticed is there's a lot of help around the table on helping companies find product market fit, helping companies look into pricing, that early beginners. And we saw that there's a huge change in what you need to do in terms of processes and just scaling. Building a company is complex, and it gets harder, and it's getting harder easier. And that's what we call the super critical stage. We created a branding for that. And we have a lot of operating support, have operating partners that have been operators before at companies like Uber and Zoom and others to really help. How do you build a company? You go from product to company. So very much bottoms up and focused on founders and the origin story. So I've known Roseanne for 13 years now. We've co-invested together. We've been friends for ages. And then in 2018, we started talking about, man, why, there's so much opportunity in building a venture firm that operates like a company. So to what Akar was saying about building a generational firm, and we had so many ideas around what we would do differently than what the environment was doing. And so we spent the better half of almost a year, like figuring out what would the business plan be. And Nisha will use the word marriage. We actually did marriage counseling, Roseanne and myself. We worked with the coach, because it's all about co-founder relationship. We pay so much attention to that when we're investing in companies, and we did the same to ourselves. So we closed Renegade $100 million fund in the eve of COVID. And since then, 2 banking crises, so many changes, and we can't understate the value of having long-term solid investors like Fairview and Illinois SURS. So excited for the conversation.
Awesome. So still staying on, the fundraising subjects, obviously that's something that we're all focused on. And that's why many of the GPs are on the call, many of which are raising their own funds themselves. So they'd love to hear some stories from both of you on that. So Renata, maybe I'll stick with you. How did you qualify LPs, communicate, and move through your fundraising process effectively as you did? And what was the tipping point for your first fundraise?
So that was the hardest part, I'll say, because there's a huge difference between curiosity and interest. And we were very lucky to find a lot of very curious and well-intentioned people. But to parse out who has the mandate, who has the true appetite to move, was a whole different beast. I think it's very helpful when LPs have a structured program, like what Akar did today, of showing this is our process, stage 1, 2, 3. Not everybody is like that. So we had to learn the hard way. So questions that were very insightful to us were, tell me about the last fund you invested. When was that? Did you ever back an emerging manager? What was it about that manager that was exciting to you? Right? Because sometimes people will say they're they want to move, but they haven't moved in a while, or what they think of emerging managers is completely different than where you are. So to understand what it is that you're looking for, and do I fit that profile? The other is when people can clearly tell you what their process is, the steps, the timeline. That also shows, especially if a program is new, shows that they have their act together. Because sometimes you'll find, things that are just kind of getting off the ground and they don't know what to do with you, and they'll keep you engaged, but it may or may not convert. And time is so limited. Because the thing with fundraising that's different than investing in a company is a company can only have one lead, right? So there is a natural urgency to get things moving. And in the fundraising where you have, a whole fund to raise, all things equal, more information is probably better for LPs. So we actually treated it like a sales funnel. So it's something that we worked on a lot on, like, what are the steps? And this is something we've iterated over time, right? Like, so what are the steps? What do people do, or what do we want LPs to do to move from step 1 to step 2, and have like a very clear definition across back then my co-founder and I of what it meant. Very much like a sales process is, this is what we did. And then the other thing that we do is we created a scorecard that my co-founder and I fill anonymously and asynchronously after an LP meeting. And part of it is rating of the quality of the meeting, and what do you think the probability of that meeting to convert is? Because sometimes I may come out of a meeting like super, oh, this went great. They're, like they're moving, and she may come with it. It's like, what are you talking about? Right. Like, and that allows us to really have a better calibration and translate emotions into actionable steps. Like, for example, we know no LP will invest without doing a founder reference. So until founder references happen, we don't count people as high probability, right? And then a lot of it is, okay, how can we actually make people move to founder references? And is there a difference between when an LP asks for founder references versus when we're trying to offer it? Does it convert differently, right? So like creating more of a structure and steps and trying to parse out true intention. Easier said than done, is a work in progress for us too.
Got it. And Nisha, how do you overcome challenges, deal with disappointments, and ultimately get your first institutional fund raised?
It's a good question. I mean, it's no secret that, both Renegade and BBG, and probably many of the people listening in today, have seen a lot of challenge over the last 5 years. I mean, between COVID, a market downturn, the Silicon Valley banking crisis, it has certainly not been the heyday of raising funds, though it has been for some people. But I think it's a great question, because not everyone talks about the fact that everyone is dealing with disappointment on the fundraising journey, right? It's really easy to see the press come out when someone's fund is announced and, they use a word like oversubscribed, whatever that means, right? They've defined it whatever way they want. And you have this FOMO or this comparison, and you say, well, why was it so hard for me? But the reality is, I think everyone is having an experience where their fundraise stalls at a certain time, or that big check you've really been relying on pulls out. And I think we've all experienced that feeling of sort of like teetering on the edge, or the existential crisis, no matter what the press says and how many people like your announcement. And so I think there are probably 3 things that I would say. Renata touched on one, which is, thinking about your fundraising process as a sales funnel. And I think the early lesson you learn as a fund manager is you need a larger top of funnel than you think you need, right? And that's the same advice we would probably be giving to our founders. But in addition to that larger top of funnel, I think it's that you actually have to start conversations much earlier than you think you need to. And, Renata and I have talked about this, right, too, but it's like, you are always fundraising. And I think Renata said something great yesterday when we were chatting, which is, don't start a fund because you love investing, right? That's not necessarily what you're going to get to do full time. You will, in fact, be fundraising all the time and running a firm. And so you've really, we talked about this, you really have to love fundraising and be open to doing it all the time. So I think getting comfortable with that cycle is really critical. I think the second is in those moments of disappointment or where you see the market turning, find a way to execute on your strategy. So proof points really matter, even in times of difficulty. When we raised our first fund, it was during COVID, and we raised half of the, and Renata and I talked about this too, right? You had done your first close, I think, Renata, the day
Friday,
the
March
lockdowns
13th.
happened.
I mean, it was locking down.
Yeah.
We didn't know if it was going to close. No, I mean, nothing worked as we thought it was going to work.
Right. And we had done 50%. And I looked at Susan and said, oh my God, we're not going to get to our target. I mean, the world is shutting down. And so we went back, we rebuilt our construction model. And so everyone should have a minimum viable fund construction model, right? What can we do with less money? And can we prove out what we say we're going to do? And so the next time it will be larger. And that's not pessimism, that's just realism. And so I think, finding a way to start investing, whether it's with a smaller pool of investable capital or it's through warehousing, means you can ride a wave and give LPs evidence that you can execute on the strategy you're selling. And so we raised that fund in 2 tranches because of that. And then I think the final one is, it's what we look for in founders, but it's persistence. I mean, we're looking for that in the people we back, and I think so too our LPs. But for us, it's certainly been a case of failure is not an option, right? We're here for the long haul, and we will find a way to make this fund work. And so even when we were staring down lockdown, I think at one point Susan said to me, we should probably think about closing the fund at X number. And I said to her, yeah, okay, yeah, we should. But in my head, I knew that we were going to hit that number. And so everyone will have different versions of that. But I think really sitting with the discomfort of a difficult fundraise and persisting through that is the way you get there in the end.
And 2021 was not normal, right? I mean, we talked to so many people with fund ones and sometimes fund twos that it takes a year or more. I remember when I joined Felice's Ventures in 2010, was the first institutional fund. I mean, it's a really well-known brand now. They had many months, many versions of a fundraising deck, right? It's hard to be an emerging manager. And I think not enough people talk about that.
Okay. And shifting to just emerging manager programs, Nisha, what has been your experience with emerging manager programs?
You're on mute, Nisha.
Yeah, I think you're on mute.
Sorry. I think Renata actually started off really well on this topic, which is understand. I think there are 2 camps, and the most valuable camp are people who have structure around the program, right? They have a process, they can communicate that process. And for us, the thing that all those programs have in common is actually what Kim described, which is people who believe the next decade of returns are going to come from managers who look different, right? So they have the thesis around emerging managers. It's not necessarily, I think diversity money is not the right term, but there is a defined thesis around why these people will have an advantage as managers and how getting in early will benefit returns in the long run. And so the Fairviews of the world, and we have some other pension funds, we have some fund of funds, they have been our most extraordinary partners and LPs because they are thesis aligned. I think what has been less beneficial to us are the folks who don't have capital yet or defined programs yet. And so are very often offering educational support, and they typically fall into more of the curiosity bucket that Renata described. And so that doesn't mean that you don't spend time with those folks, but you have to differentiate between I'm learning, I'm trying to build a track record versus I'll have capital at some point, and this is the right person to build a long-term relationship with. So it is a very fine line of that qualification, I think, that Renata described.
Yeah, and if I'll add on here, some programs have special terms or they mean well, but they may actually create something that is off market and that you have to live with for the longest time. So everything from unique economics to other governance requirements, and some of them may have side letters. So if you're talking to programs like that, ask them, do you have side letters? Do you have special requirements? And see that early in the process so you can figure out what's right for your business, and you can get aligned and not, spend so much time to learn in the 11th hour.
Well, this has been a great discussion. I want to leave a little bit of time for Q&A, but thank you very much. Kola?
Yes, fantastic discussion, and lots of questions have come in as that has gone on. So we'll try and get through as many of these questions as possible. Probably the first one to get through is actually more of a logistics thing. And Chrissy, I'm going to ask you this. So lots of questions about whether the webinar will be emailed, whether it will be shared, will there be a recording, and how do people access that? So you just want to speak to that?
Yes, a replay will be available. That will be issued to all the participants that are on the phone. We have your contact details, so we'll make you aware of that once that's available.
Okay. There have also been some questions talking about EM programs, particularly in light of the recent Supreme Court decisions, and if there is, and also some lawsuits against, a specific fund that invests in diverse managers or makes grants to diverse managers. So the questions essentially are, how's Illinois thinking about this? How's SURS thinking about this? Are you doing anything specific to protect? How do you feel about the programs in light of these recent decisions? And maybe I'll ask him to speak to that.
Well, I'd say, first of all, that is a great question. I wish my crystal ball was more clear, but the ruling is new. We certainly are talking about it internally, and we need to do some more thinking, I guess, and reviewing of potential implications there. So it's no hard and fast changes to date, I would say. But on the one hand, though, we reviewed the Illinois statute. We feel like we have some pretty strong direction from the state in statute. So that's something that we're basing our decisions on. But there certainly is more discussion on that to come. I don't know if you have anything to add, Kola, or Connor.
I think you've answered it, Kim, and it's early days.
Yeah.
I think the fact, and again, it's not by chance, and that's always been consistent, the focus on performance.
Absolutely.
Where again, we're doing and constructing these programs because we genuinely believe and have shown that there is an underserved market that, when invested in properly, can generate returns that are superior to what you will just get in a broad private equity portfolio, and that are accretive, to the programs of our clients. And that's what we strive to do. That's what our clients strive to do.
Absolutely.
I think on that basis, it meets every fiduciary test that I can imagine. So, but who knows? There was a specific question about veterans and whether they count as minorities since they're an underrepresented group within VC. Aka, do you want to speak to this?
Yeah, I think that we're definitely inclusive of veterans in the Lincoln Fund program. So that has been kind of an active part of the pipeline. So it's certainly open to veterans.
The next question, again, Kim, I'll have you take this. And it's around, so there are some emerging managers or newer funds that are not necessarily diverse. And, how do those fit in your program and how do you access this opportunity set?
Okay, that's a good question. So if a manager, I guess, does not fit in the Fairview program, for example, our other discretionary partner is Axia. And our contacts there, I think I listed on a page, but Mike Krems and Heidi Poon. And they have, while their program for us starts at roughly 300 million, although I don't know that there's anything hard and fast about nothing special about 300, but I guess the first step or my recommendation would be to reach out to them and start building that relationship, start building that dialogue with Axia. And that would be the way to, potentially enter the SURS program there.
Thank you, Kim. Question came in specifically directed at Renata and Nisha. And it says, curious how you dealt with the opportunity cost of leaving established firms to now go found your own emerging manager firms.
Yeah, I mean, we really didn't have to do it from that perspective, right? I was at Luxors and I was at IVP. But at the TLDR is we just thought we would make more. The expected value of doing our own thing was actually bigger, even though the beginning was harder, right? So we really found what we would work on. We'd spend time working on our partnership. We did not have anchor LPs when we left. We know some people that actually figured that out. I mean, Roseanne and I, we jumped into the black hole of starting something without guarantees, but we are renegades. Like, we believed in what we were building, and it was an opportunity. It came from like good ambition, and it's not easy. And we were in a lucky position to have the financial means, I guess, to be able to afford to fundraise for a year and get stuff started. All of that. Not simple, but you got to believe.
Yeah, I mean, not too much to add to that. We weren't theoretically at a name firm, right? We had been working together at AOL, but we didn't have the comfort of a solo LP. And so we were fleeing the coop of that comfort, essentially. Again, we were fortunate that we had some small management fees that could support us while we went out to raise the first institutional fund. But I think in our case, I mean, it was very much about high conviction that what we were focused on did not exist in 2014, and that we felt that ultimately we would not be able to do that as part of a larger platform, right? If we said we really like investing and we wanted to go join a large brand name fund, I don't think we would have been able to help define what's essentially a new category in VC investment, or at least was at the time. And so that in and of itself was so compelling. And it's, again, something we look for in our best founders, right? That you can't get this idea out of your head.
Thank you very much. There's several other questions. I'm just going to knock out two that have been asked in different ways by several people, and I think are important. And then we will wrap up. But then any questions that we haven't answered, we'll go directly to the questionnaires and get them responses within the next day or two. So there have been quite a few questions about credit, and if this was part of the other bucket. The answer to that is yes. It is part of the other bucket and would be considered as long as it meets all the other criteria that we had discussed.
Hey, Cola, can I jump in on that private credit? So in addition to the Lincoln Fund, we also have a separate private credit portfolio. And then we work with Makita. Makita is our discretionary advisor there for SURS. And so Makita has the same kind of direction that Axia does, where we expect 20% of the commitments to go to diverse firms. So another avenue, I guess not covered on this call, but would be to reach out to Mary Bates at Makita to talk about private credit. Well, thank you.
Yeah, you're welcome, Kim. And then the last question is just, how to apply or how to get into this program. And essentially, I think Kim had already shared details about the SURS Diverse Manager Portal. Also, if you go to the Fairview website, we have a link for Connect, or you can email connect@fairviewcapital.com, and we will respond to every outreach that's made to us, and screen those, give you input as necessary. And that's what, we have what we call an open door policy, something we're very proud of, and we'll be happy to take that kind of outreach. But on that note, I want to thank everybody that has taken time to attend this webinar today on behalf of SURS and on behalf of Fairview Capital. Thank you very much for your time, and we look forward to engaging with you in the months to come. Also, thank you very much, Renata and Nisha, for taking time to come spend with us today. Take care, everybody.